So the current debt market update. Um, since our last call 2 weeks ago, there's not really been any big swings or changes. The treasuries are up a little bit compared to where they were 2 weeks ago, maybe 10 basis points. But compared to what they've been changing, over the last year or so, that's very minimal. Um, current rates, the rates are all over the place. Um, I've seen rates as high as 15 and 16% for hard money. And I've seen rates as low as the mid fives here recently for, larger multifamily deals. So that's a big spread. And, there's a lot of different property types out there. So, the federal funds rate, we're still at the 5.25 to 5.5, the highest in 22 years. The 10-year Treasury today finished at 4.18, and the 5-year Treasury at 4.09. The Treasury rates more or less determine the rates that we'll pay on multifamily. So, um, so the Treasury rates, when you're looking at properties. Hey JJ, are you on here? Try to keep people coming in as they come into the waiting room.
I got it.
Oh, okay. All right. So when you're looking at the treasury rates, and you're looking at, properties that your loan amount is going to be larger than 7.5 million, I say that, that's the conventional, for the agencies, that's a conventional loan amount. So you're going to add like, take the treasury rate if you're looking at 5-year term of 4.09, you're going to add 1.5 to 2.5 to that 4.09. Depending on the property type, you know, have an affordable, housing component to the property is going to help your rate come down. The location being nicer is going to help your rate come down. Um, but so you can take that if you're looking at, wanting a 10-year rate, 10-year debt, you can take that, 1.5 to 2.5. I would say just add a two to that 4.18, and your final rate will be, in the 6.1, 6.2 range. Um, and it kind of works the same way with the 5-year. When we're looking at the small balance, Fannie Mae, a small balance is anything less than 6 million, so 2 to 6 million loan amount. I would add 2 to 3 points um, on top of the 10 or 5-year. Um, with Freddie Mac, that's 1 to 7.5 million is your small balance. So hope that makes sense to everybody. I'm looking at a property, my rate, the cost of the property is 15 million. My loan amount's going to be in that 9 million range, 10 million range. I'm in the conventional space, so I'm going to add, if I'm looking at 10-year debt, I'm going to add, let's say, 2.5 to that 10-year. So the 4.18, you're going to end up with, you know, 6.5, 6.6 on your debt. So, and we'll be taking questions later if anybody has any questions on that. Right here, I don't always put these in, um, but this here is our latest rate sheet. So you see the Freddie Mac and you see the Fannie Mae at the bottom. Fannie Mae is 2 million to 6 million. Um, the Freddie Mac small balance is 2 to 7.5. And if we have a property that the loan amount's going to come in, above 1 million but below 2 million, we can get special exception on those. Um, and these are multifamily rates, y'all. You know, when we're looking at, so many different types of commercial real estate out there, these rates are good for multifamily that qualifies for, Freddie and Fannie. Um, won't qualify for hotels or office or industrial, anything like that. Everybody got a shot, picture and all that of that. I'm going to go ahead and go to the next slide. Um, so kind of where we've been for the last year and a half. Um, the market's been stagnant. We have sellers who, some of them need to sell, or maybe they need to refinance. They can't refinance because they owe more than what they can refinance for. There's a lot of different situations going on out there. Insurance rates going up, taxes going up, and then we have, the issue with the loans going up. So, you know, these loans, a lot of them that people were taking out a couple years ago were just, a had terms of just a couple years at some points. And so when that term would come up, their rate would come, from 2.5 or 3%, and it's bumping up to 6.5 or 7%. And so it's just killing cash flows on these deals. Um, and it's put a lot of people in trouble. Um, the valuations of properties have come down because of it. Um, and there's really no way out for people at this point in time except to either continue pulling money out of savings or whatever they have to try to hold on to these properties, or to turn around and sell for a loss in a lot of occasions. Um, and it's created a stagnant market because people that don't have to sell are not selling. Um, we still have plenty of buyers, people wanting to buy out there, um, but they can't afford to buy a lot of times at the prices that people are wanting to get for their properties. And so because of this pain in the market and people, having, the adjustable rates, you've got, the taxes and insurance, all these things that are kind of hitting the market all at once, you know, there's going to be a lot of opportunity coming to the market. All these things, the higher taxes, the higher insurance, the higher rates are killing the valuations of properties. It's killing the NOIs, and so the values of the properties are coming down. Um, and so we're at the beginning stages of a major correction in the market. You know, there's $2.7 trillion of debt maturing by 2027. Half a trillion maturing by 2024. Half a trillion maturing by 2025. 15% of all commercial real estate loans are underwater, and I believe I've heard different numbers, but a large percentage of those are office. But there is, when they're looking at properties that are underwater, they're looking at properties that are worth less than what the loan amount is. So we're not at that point right now for multifamily. Uh, because a lot of these deals, were leveraged 65, 70%, 60 to 75% a lot of the time. And so the properties would have to almost cut in half in value for a lot of the multifamily to be underwater. And they haven't cut that much, 15, 20, 25%. So a lot of people, I've seen a lot of people that, owe what the property is currently worth, at a 6 or 7 cap or whatever it would be. So, but that's really not underwater, but they've lost all their cash. So, um, definitely pain in the market. But because of that pain, we're going to start seeing more and more opportunities. So, as real estate investors, this is a great time to buy. So to say, kind of the doom and gloom that I was just talking about, as an investor, this is all good stuff. This is all good stuff that's coming about, if you're wanting to buy deals and to get good pricing on deals. So